Real estate versus stock market, which makes you more money? Real estate versus stock market, pros and cons. Welcome to another video. Today, we discuss the pros and cons of the real estate sector and the stock market. We will provide comprehensive information to guide your investment decisions and generate enormous wealth. Let's begin. Pros and cons of the stock market. Pros. 1. Liquidity. Accessing money invested in the stock market is easier compared to other forms of investment like real estate. It gives you the opportunity to trade, sell, or buy based on what you want to do at a given time. This makes it easy to access your money when you need it without having to wait for a long period. The investor or stock owner is therefore able to continue investing in other areas according to their usual plans. You are also able to liquidate your stocks quickly if you sense some imminent negative changes in the market to avoid losses. 2. Potential for high returns. When you understand the stock market well, you can monitor the performance of various stocks you want to invest in and make a lot of money. You can also use experts to ensure you buy the right stocks that show a tendency to grow in a short time, depending on the perceived changes and trends in the market. Using the right tactics can make you rich overnight. However, it is essential to be cautious and understand the risks of the game before investing in stocks. 3. Investment capital. When investing in the stock market, you do not need to start with a large amount of money. You can start small and grow your portfolio depending on the availability of funds. You can choose to buy low-value stocks but buy many with the hope that the value will increase over time. This is good for long-term investments where you are not in a hurry to liquidate. 4. Increasing stock ownership. When you invest continuously in a stock, you can end up owning a huge share in the companies you have invested in. It is known that investors have bought companies by investing in their stocks consistently for a long time and increasing their stock capacity. 5. Diverse earning paths. In the stock market, there are several ways an investor realizes their earnings. One way is from the increase in the value of stocks, which you enjoy when you sell and realize profits. The other path is through dividends that are normally paid annually. This, however, will depend on whether the companies make profits or not. Cons. 1. Stock market crash. Due to the volatile nature of the stock market, there is always the probability that stocks can lose value in a very short time and can have devastating effects for the investor. Once a market crash occurs, it might take time, even years, to recover, depending on the reason for the crash. It is important to keep this in mind as a potential investor. 2. Market volatility. The stock market can sometimes be very volatile, and investors can lose or gain. Keeping this in mind, it is advisable not to put all your eggs in one basket but to distribute the risk. You can create a portfolio that ensures you are protected from the inevitable market fluctuations. 3. Poor or no dividend payments. It is known that investors have encountered disappointments when the stocks they invested in did not issue any dividends. This mainly depends on the performance of such stocks in the market. Poor performance will result in poor or no dividends, and vice versa. Some companies might also decide to withhold dividend payments and channel them towards development projects within the organization. Without any control over the performance of the stocks, you can buy stocks of various companies thinking you have some influence over how the companies operate. This might not always be the case since most decisions made on the management of the companies might not be known to all shareholders. Only the major decisions made during the annual general meeting are open to shareholders and sometimes to those who own a large share of the company. 4. Long-term investments. The stock market works best for long-term investors. This is for those who are ready to wait for their stocks to grow in value before selling them. But for short-term investors who need short-term gains, This might not be good if they buy stocks or securities during a slump or right after. They risk having to wait long for the value to increase to a level where they can sell and realize good profits. 5. Time-consuming. When you decide to invest in stocks, it is not always a walk in the park. You have to do a lot of research and understand which stocks are doing well at the moment and in the long term to get to the profitable stock. You also have to do an investment analysis to guide you. After deciding which stocks to buy and completing the buying process, you have to constantly monitor their performance so that you know when to sell and exit. When you observe carefully, you will be able to tell if you bought poor stocks and will not be caught by surprise if things go wrong. Pros and cons of the real estate sector. Pros. 1. Control. When it comes to real estate, you have more control over your investment compared to other forms of investment like stocks. The investor has control and is able to manage their property without having to wait for others to make decisions for them. This makes the decision-making process easy, and you are able to seize any opportunity that comes without procrastinating. You have control and can devise strategies and steer your business in the direction you want to take. 2. Leverage. The real estate sector can be used as leverage to get your wealth faster and also develop your real estate empire. This can be used as a tool to minimize risks in your path to increasing your assets. You are able to use borrowed money in the form of loans to increase or boost the return on investment. Financial leverage offers a crucial advantage to those investing in the real estate sector as well as potential investors and can help you grow in the real estate market. 3. Property value increases over time. In most cases, the value of real estate increases or appreciates over time. However, we cannot forget the cases where you might buy a property in the wrong place or where it is negatively affected by events beyond control. But there are many times when, with adequate research, you can identify a good property that will grow over time. The other beauty of a property is that you can make modifications and increase its value, putting it in a position where it can earn you more when sold. 4. Provides income stream. If you decide to invest in rental properties, you are assured of a periodic income stream, whether monthly, quarterly, or annually. This can allow you to explore more opportunities in the real estate market and increase your value. The rental income will give you the freedom to carry out other activities as it does not tie you down even when you manage it. It is one of the best forms of passive income. 5. Grow your net worth. The rental income can be used to clear any debt you have on your property. If you took a loan to purchase a property that you rent out to tenants, you can use the earnings to clear the loan and continue making money for maintenance. A well-managed property is able to grow your net worth without you having to spend anything out of your pocket. At the end of the day, you will be the owner of the property without any debt, and all the returns will come to you to invest eventually in more areas of your interest. In this way, you increase your net worth and wealth. 6. Protection against inflation. It is known that when the value of money decreases, the resulting effect is that prices take an upward trend. The rate of inflation affects the value of most investments. The purchasing power of money decreases or increases depending on the rate of inflation. The good thing is that real estate investments are able to keep up with inflation. In fact, inflation normally pushes the value of the property upward, making it profitable when sold a few years later. For those who rent or renew the lease agreement every year, they have the opportunity to increase their rents upward to counter inflation. Cons. 1. Low liquidity. If your intention is to buy and sell and realize quick profits, real estate investments might not be for you. This is because some properties are not easily sellable and might take months or even years to find a good buyer. When investing in real estate, it is better when you focus on the long term. If your intention is to turn your money around quickly when you intend to sell your property fast, you might end up selling at lower prices, making you lose substantially. 2. Creates passivity. You cannot compare real estate to a loaf of bread. When you invest in properties, you end up with many legal and financial responsibilities. Managing the property, renting or leasing, as well as maintenance, adds to the responsibility. There is always a nagging risk that you might lose the profits and income that your property brings, particularly in terms of rents, where tenants might decide not to pay for some reason, like financial difficulties. It is not uncommon for tenants to damage the property and not maintain it well. 3. High transaction costs. Compared to other forms of investment, like stocks and others, the transaction cost involved in real estate is high. Normally, when you buy a property, a huge capital is involved, and since most taxes and costs are calculated in percentage, you end up with a high cost for every transaction made. Investors need to be aware of this to ensure they have adequate capital to cater to all costs involved in their purchase. 4. Property maintenance and management. When you own a property, it becomes a responsibility to manage it well and ensure it is fully maintained, not only to attract clients but also to avoid huge management and repair costs. Damage to the property by tenants can result in high maintenance costs and reduce the value of the asset. If part of the property is not occupied for some time, it does not exempt you from incurring some maintenance costs because, in that case, you are spending money on the property but not getting any income, making it a loss. Hiring managers to manage your property if you cannot do it yourself is also costly, and the management fee will erode your profits. 5. Competition. This can happen when your property is among others in a highly competitive area. New properties are always coming up with more improved and updated structures. What is likely to happen in such a case is that tenants are driven to jump from one selling point to another, which can result in losses due to vacant properties, especially if you do not constantly update the property. Consumers will always focus on where they can get value for their money, hence the need to always be a step ahead. Share your personal experience on today's topic with us. Write it in the comments and ask us any questions you may have. We will be happy to answer. Leave a comment so that we can perfect our creations. We will be happy with your simple like, but the most important thing is not to forget to subscribe to the channel so you don't miss the upcoming videos.